Hey, everybody, welcome to the daily update for Wednesday, April 29th, 2026. Happy hump day. As you can see, my voice is still not back. I'm right at that spot where if I wake up tomorrow feeling significantly better, I know that I'm on the downside of this cold. If I don't, probably have 2, 3 more days. So, anyway, I'll make it through it. Big day today, FOMC. We've got Amazon, Google, Meta, a bunch of earnings after the bell. We'll talk about all that in a little bit. But what I wanted to do is I wanted to talk about this interview that recently was put out by Paul Tudor Jones. And what I'm referencing here is Patrick O'Shaughnessy put out this great interview with PTJ. It's about an hour and 15 minutes. You can find it on his Twitter feed. You can also find it on mine. I retweeted it. You can also follow Paul Tudor Jones. So you're probably asking, or some of you might be asking, well, who's Paul Tudor Jones and why do I care? Paul Tudor Jones is a legend in terms of markets. He's one of the original market wizards. His original claim to fame was predicting accurately the 1987 market crash where he dropped 23% in one day, in which he made a boatload of money. But what I like about Paul Tudor Jones, opposed to all the other legends of the markets, is he's one of the few legends that we can actually, as retail investors, retail traders, get some advice, some tips, some lessons from. George Soros has written 3 books. I challenge you to read all 3 of those books and tell me one actionable piece of advice or information you can get from George Soros. The best you can do is he says, when his back hurts, he knows his position is too big. How does that help us as retail traders? It doesn't. Same thing with people like Jim Simons, amazing hedge fund manager, super profitable, but has a quant mind and a quant team that just is not accessible as retail traders. So Paul Tudor Jones, original mentor, was a cotton trader in, I think, the CME pits. He comes from that real on-the-ground trader attitude. If you get a chance, find his, there's a little documentary that was made on him in the late 80s, early 90s called Trader. Just Google Trader, Paul Tudor Jones. It's fascinating. So this guy has always had his finger on the pulse of what trading is about. So I watched the whole interview. I would encourage you to watch the interview. I've extracted 5 lessons that I think were really unique. And what I'm going to do is I'm going to take these lessons, I'm going to try to overlay them on some of the things we try to do here in the Lund loop and make them a little bit more applicable to what we do as retail traders. So let's just jump to it here. So the first lesson is this: ride trends longer than feels comfortable. Most real money is made by sticking with a trend for the very, very longest time, not by constant trading or timing every move. I've talked many, many times here about the 5 different styles, 5 different strategies for a position: scalp, day trade, swing trade, active investment, and long-term investment. And I've always said that for me personally, a swing trade gives you the best bang for the buck, the least amount of management and micro attention to the most amount of profit. Swing trading is obviously where we want to be. The market doesn't always give us opportunities to have swing trades, but when we have them, they can sometimes go longer than we think. For example, if you take a look here, coming out of that tariff tantrum, there were names that just went trend mode for month after month after month after month. There was no need to be micromanaging positions, no need to be involved in day trades. I mean, you could do that, but there were so many names that you could have made a boatload just by sticking with that trend. All right, what's next? Risk management is the core skill. Anyone who succeeds as a trader or investor is first and foremost a great risk manager. Everything else is secondary. Amen to that. Why? Because if you don't have capital, you can't play the game. So you always have to be looking for not how much you can make on something, but how much you could lose on something first. Now let's go to a very recent example on the. Let's take a look at good old Poet, and you can go back a couple days and look at a breakdown on what I did with Poet. But I think the problem that people have when they hear the word manage risk or the phrase manage risk is they think, oh, well, I've got a stop in at 10% on my position. So I've managed my risk. But as we're going to see in another slide, that's not really risk management. I look at risk management holistically. There's a lot of different ways you can employ risk management. So, for example, let's say, so you get this breakout on Poet and you get this 3-day run, and then you get this little pullback here, kind of a hammer, a little pause. And let's say you want to trade this, okay? Risk management here means you trade a smaller position than you normally would trade. Why? Because the stock has gone from $7.44 to $12.86 in 3 days. If you're taking a position here or position here, you have you can have a larger position, right? You can be positioning for a breakout, but once the breakout's happened, you've got to adjust your risk. Okay. Another thing that people don't do, like we talked about this was a position I was trying to hold for quite some time. And if it just slowly ground up for months from 7 to 15, I probably would have held all my position, but it went up 108% in 1 week. You have to adjust your risk management in those situations. There's other ways you can manage risk. For example, if you have a stock that you think looks good on a daily chart and is getting ready to break out, you can buy it the day before, right, and hold it overnight, or you can try and buy it at the open the next day. Those are two different examples of risk management. One, you're taking overnight risk, and maybe you're okay with that, and maybe you do that and you take a smaller position, and that together lowers your risk. But maybe you say, you know what, I want to take a bigger position on this. I'm going to have to wait until it opens so that I can manage my risk in real time. I don't have to worry about that gap overnight. You can take risk in terms of your portfolio, right? You can have certain names that are bigger or smaller parts of your portfolio, and that can affect the risk of everything that you have. So risk management is way more than just where you're going to have your stop. All right, let's go to the next one. Next one is liquidity is survival. And this is related to the previous one. Never trust positions that can trap you. Markets can collapse fast, and you're only worth what you can access or write a check for tomorrow. So Tudor Jones, I don't know if you say Jones or Tudor Jones. I'll just say Tudor Jones. Tudor Jones talks about one of the Hunt brothers and how he went from one of the richest people in the world to almost bankrupt seemingly overnight when silver collapsed. And what he means by that liquidity is survival. It's not your account liquidity. It's the liquidity of the instrument that you're in. This is why I try to avoid at all costs biotechs, why I try to avoid most ADRs, why I avoid stocks that are very choppy, that they're thin. We talked before in the previous slide, oh, I'm managing risk because I've got a 10% stop. But what happens if you wake up and your stock has gapped below that 10%? Now it's down 30%. We just saw this with Poet. Poet was down 35% before the open. You couldn't sell shares pre-market in some accounts on this. So what good would a stop right here do? It doesn't help you at all. Let's take another example of liquidity being survival. So there's a stock that was put on my radar in the trading room recently by a Lund subscriber. And I don't know the full fundamental story, but this is something related to space. And it's a stock that's had repeated reverse splits, dilutions, whatever. But it's been perky lately. It does have times when it pops up. You can't trade this stock, in my opinion. You can't trade this stock because it's not liquid. It doesn't have enough liquidity to keep it from gapping down overnight. So I bought some of this stock. I bought it twice, but I'm buying it in a very specific way. This stock, the way I'm approaching it, it's either going to go to the moon or it's going to go to zero. There's no in between. How am I going to try to manage it? It's hyper illiquid. So I know the context of this stock. I may not be able to get out of this stock when I want to get out of it. So I'm sizing my position accordingly. And I understand that it's either going to be a big win or it's going to be a big loss. So I'm changing my strategy, changing my approach based upon the lack of liquidity in this stock. But as a general rule, I avoid stocks where liquidity is an issue. All right, let's go to the next slide. Wait for extreme emotion to act. The best trades come at points of maximum fear, buy, and maximum sell, not in the middle. Okay. One of the things that Tudor Jones talks about is how he's made lots of money buying the turns in stocks. But he says, I'll buy the turn 6, 7, 8 times in a row. I'll be wrong, right? I'll buy it, get stopped out, buy it, get stopped out. Nobody ever sees that part. They just see that, oh, I bought the turn, right? But he's basing those turns, or at least the first attempts of those turns are based upon extremes in emotion. So let's go take a look here. Let's go back to the SPX. So, and I think this tends to be a little bit more applicable for retail traders when it comes to investing than it does trading, because trading's really hyper specific. It's hard to find extremes of emotions, because extremes of emotions when you're trying to trade or pick a certain spot in a stock, those extremes can get even more extreme. But remember last year when we had the tariff tantrum and we were falling off a cliff? Remember I did the daily update and I was actually laughing like a mental patient because the price action was so ridiculous here. And we started to hear these calls about how America's century was over, about how we were no longer the 800-pound economic gorilla in the world, and just really extreme fatalistic outlooks on American exceptionalism and the economy and where we were going to go. Those are the times when we started picking up a lot of names because the emotions were at an extreme. And then when they turn around, look at that. You got this beautiful reversal and then trending for months and months in the opposite direction. So I think that the emotional extremes work better when you're trying to put money into the market, like when you're trying to index invest. Like I would say maybe for bear markets, when you're getting close to the end of the bear markets, or when you're doing like a blood in the street type of thing. I think it applies a little bit more with that than it does when it comes to individual names. But you could also go back to Poet and look at that, that extreme move here. And if you were watching FinTwit, you were seeing everybody, Poet's going to be $100 stock. It just went up 108% in 5 days. Is going to be $100 stock. Well, okay, maybe not, but big chance you're going to get a pullback, and a pretty good pullback before that. All right, let's go to the next one, the final one. And this is: big opportunities are rare. Be patient and strike hard. Trading is like boxing. Most of the time, you're waiting and observing, but occasionally there's a clear opening. Those are the moments to take your big shot. This trues up with something I've been saying for a long, long time. Trade less, make more. I feel like what we do here is we are always looking at where we are in the continuum from risk off to risk on. Where's the market in terms of a 0 risk off to a 10 risk on? We want to be involved in names when we're more on that risk on market, because we have a tailwind, right? So we take where we are at in the continuum, then we look at what names are coming onto the watch list and setting up, and then we look for the best spots to get involved in those names. And I think that trade less, make more. Like I'd rather make all my money during the year from 3 to 5 trades than I would grinding it out in 20, 40, 60 trades. It's just too much. It takes too much mental energy. It's just something I don't like to do very much. So waiting, picking your spots, I think that is a major, major advantage that we have over other traders. I think it also goes back to that thing about not managing positions, managing time, managing energy, right? It takes a lot of energy to be chasing all these different trades. I think of trades as skirmishes, battles, and wars. I don't want to be involved in the little skirmishes. I don't really want to be in the battles. I want to be in the big wars. I want to win those big wars. Wars don't come around that often, thank goodness. But that's where I want to be placed. So, all right, let's go to the full rundown of the market.